And today we're talking with John Casella, who is the CEO of Administrative Outsourcing. Welcome to the video, John.
Pleasure.
Yeah, tell me a little bit about yourself. Tell me what your company does.
Well, I'm both Canadian and Italian citizen. Grew up in Toronto. I have active CPAs, both Canadian and US CPA. Started my career at Arthur Andersen in Toronto, and after 5 years of audit and tax and advisory services, I decided it was time to travel.
Great. Well, today we've invited you to talk about the tax changes that were put into place last year and prospective tax changes as well. A lot has been said about the tax changes that were announced last year in September and put into place from January of this year, and these affect the remittance of overseas income into Thailand. A lot of people are panicking about that, and a lot of people are worried about what it means. Can you explain it for the layperson and what this means?
It's applicable to tax residents, first of all. So if you're not a tax resident, if you don't spend more than 180 days in Thailand, you're not subject to this change in guideline. And in 1998, to go back a little bit before my time, there was a guidance that came out from the Revenue Department from a Supreme Court decision that said that you had to only pay taxes on foreign income you remitted in the that you earned in the same year. The new law, it's not a new law, it's just a new interpretation of the existing law, is that now income that's earned starting 1st of January 2024, that's earned overseas when brought into Thailand is taxable. It's taxable if it is, in fact, foreign source income, if you're a Thai tax resident, and it has to be remitted into Thailand, and if it's remitted into Thailand from a foreign source that has a double tax agreement, then you can also get tax credit relief on that income to the extent that you're subject to taxes in foreign jurisdictions.
A lot of people on fixed income have pensions from Italy or Europe or the UK, and they're worried that they're going to pay taxes in Italy and also have to pay taxes in Thailand. And Italy is a signatory to a double tax treaty with Thailand. So what's your advice to these people? How do they handle the income coming into Thailand?
The income coming into Thailand, in fact, being subject, presuming in the case that it's subject to taxes in Italy, which in most cases it would be, then we don't, because the law was enacted in 2024 and we haven't yet filed for personal taxes in 2024, which doesn't start till January 2025, the PND 90 and PND 91 has not been issued. So the technicalities of how to file, for pension income, you would be you would expect that the tax form would say that you include the income into other income, and then there should be a space, and there are spaces for tax credits, but not specifically for foreign tax credits that should be added to the tax form.
There's two points that I'd take up. And I'm sorry doing that, but I'm a lawyer, so I'm going to pick up 2 points that you said. Income earned from 1st of January 2024. So if I earned money in 2023 or 2022 and sent that into Thailand, and I could prove that to the satisfaction of the IRD, that would be non-taxable?
Exactly.
Okay.
Exactly. So there's not so much to worry. As in Italy, I can assure you that as in Canada or the United States or most Western countries, the tax rates are higher on pension income or most sources of income. In fact, dividends, and we'll talk about that maybe a bit later, dividends, capital gains, interest, pension income is really not the risky income that's being addressed by this guidance, this change in interpretation of the revenue code. It really affects more people earning direct profits, providing services, having a job, or having paying source of income, rental property and remitting rental from income from overseas directly into Thailand without putting it into other investments like capital and whatnot.
People are very concerned that their income is going to rise because of this new legislation and new interpretation of legislation. There are ways of minimizing tax within acceptable guidance. The word you used was income. So transfer of money from overseas that is not an income would not be taxed.
Exactly.
Is that correct?
Exactly. So, I mean, the easiest form, and the one that I would personally use, being married to a Thai, is gift to my wife. You're allowed to gift up to 20 million baht a year to a family member, and I don't foresee myself needing to bring in more than 20 million baht into Thailand from overseas in any given year. So that to me is a no-brainer. There's also what any good, I think, tax planning person with a portfolio should be considering: rebasing your assets so that you're selling your stocks and rebuying them, for example, so that you realize the gains outside of Thailand, and then when you come to bring them into Thailand, your tax base is high. Another way to bring in funds from overseas, from a foreign company, if you have one, would be to loan the money to yourself in Thailand, to your company or to yourself personally. Loans would not be taxable except for any interest that might be related. But again, the Revenue Department isn't concerned about the interest you're paying on a loan from overseas, so that's quite an easy way forward. And the last would be the long-term resident visa, which you and I have talked about in the past, and that has its own royal decree that declares that anyone with a long-term resident visa is exempt from foreign income regardless.
One of the things that also has come up in the media, people have got up in arms about, and we've got many inquiries, is this idea of global taxation. At the moment, Thailand is a territorial taxation country, meaning you pay tax on what you earn in Thailand or bring into Thailand. And I recall in Bangkok Post article, which many people have seized on, that there's a possibility of global taxation, which is done by very few countries, actually.
I see that as highly unlikely for a number of reasons. The Bangkok Post is the only newspaper that has reported on this. The report itself was not very clear. It wasn't. It ultimately, after its second or third update, named the source being the Director General, having apparently said this, but the Director General has never been quoted elsewhere as saying so. As well, it's factually got poor examples, such as an example of what would be taxable under the foreign remittance, which is actually not even a really taxable situation. So I have a healthy amount of skepticism that report is credible. I'm not going to say it's fake news. I'm going to say it's clickbait at best. And then finally, it would scare away people from moving to Thailand. It would disadvantage Thailand within the region, within its neighbors, and it would require a whole new law to be approved by the cabinet, by the lower house, by the upper house, then by royal assent, and then they would have to be able to implement the law, which worldwide income is very difficult to determine and requires a lot of resources and a lot of investigative skills. I think the Revenue Department would be better to spend time focusing on other sources of income, including just taxing residents of Thailand who are earning in Thailand outside of the scope of the Thai Revenue Code or outside of tax filings. Okay.
Common reporting standards. So Thailand has signed up to be part of the global consortium, which will swap banking information about residents and non-residents. What do you see that as doing for the taxation department, or can the taxation department use that, and what will they do with it?
Well, I think it's not coincidental that the guidance that refers to foreign income remittances was announced in September, the same month as a common reporting standard came into action, because at that point the Thai banks are required to provide the information, as are most of the source banks that are sending the money into Thailand, already part of the OECD, and therefore already recording the details of the transactions. So the Revenue Department has access from both sides of the transaction to see that if I send money to myself from overseas, it can raise a red flag, and that just gives the Revenue Department the opportunity to identify what previously they could not identify as potential foreign source income remittances from Thai tax residents who are bringing funds in, and then that gives them the opportunity to check whether or not maybe taxable income is coming into Thailand, and that's where they should be spending their resources, really. And there are a lot of more high-end wealthy individuals than your average pensioner who's already being taxed in their home country, bringing in funds that previously were never taxed because of the old guidelines that allowed you to bring foreign income in the year after it was earned and not get taxed. Yeah.
So in summary, these tax guidelines are such that you keep good records, you see a professional accounting service to help you with your filing, and it should have a minimal impact on the average retiree, the average person living in Thailand. Yes. Would that be a summary?
Yeah, very good summary. I mean, you have to take care of what you bring into Thailand and make sure that it's safe to bring in before you bring it in, and it's relatively easy to make that safe if you know what you're doing.
Thanks a lot for spending time today, John. And don't forget, John is a Thai-Italian Chamber of Commerce member and attends many meetings, so please pull him aside and have a chat with him if anything today is of interest.